Let's bring in two more voices on this in the broader market. Joining us now is Unlimited Funds CIO Bob Elliott and Macquarie Group's Thierry Wizman. Good afternoon to you both. Bob, I'll start with you. I mean, the S&P basically ended the day flat, 42.05, but it was a mixed picture. How much is the market baking in and absorbing this debt deal and all of this now, I guess, hashing out, you could say, in D.C. among lawmakers?
Well, I think a lot of the benefit to the markets that came from the acknowledgement that the debt deal was going to finally come to fruition happened last week. And so I think in many ways, what we're seeing right now is the market's taking a breather and digesting the actual news following a relatively sizable lift before. I think the more interesting part is the market action in the bond market, which really saw a pretty good bid today, which was interesting in the context, even quite a ways out the curve where there wasn't that much concern about immediate default the way there was in T-bills. And I think that reflects the fact that there really was some underlying concern in the bond market, and part of the sell-off that we saw in the back half of last week and recently was driven by debt ceiling concerns from a variety of different investors.
Yeah, Terry, we did see this relief rally in treasuries. I just wonder if it's going to be short-lived, because now all the attention is focusing on the Treasury general account and the fact that you're going to have to see this big issuance to refill the coffers there, and that's going to suck liquidity out of the system, and maybe, therefore, we see a lot more volatility in the bond market moving forward.
Yeah, well, first of all, I do agree the more interesting dynamic is in the bond market and fixed income. Look, what's been happening over the last few weeks, I think, is that the traders, fixed income traders, bond traders, have actually gotten ahead of the prospect that there's going to be quite a lot of net new issuance coming out of the Treasury. Estimates range from anywhere from $250 billion to as high as $1 trillion to be issued over the next few weeks. They got ahead of this, which means this is the reason why Treasury yields had been going up so much over the last 2 and 3 weeks. In fact, you can see this by looking at the positions of traders reports on the CFTC. They show a very massive short position in bonds right now. Now, when I see a massive short position in bonds, I'm inclined to think, well, no, we might get a short squeeze here. It's very possible, even though we do get this massive amount of issuance coming out of the Treasury, the market is so short the bond right now that if they just normalize their positions, cover their short positions, we could see yields lower, not higher, despite the flood of this issuance. How low? Maybe the 10-year goes from 3.7 to 3.6 or maybe 3.5 before we finally get all of the short positioning washed out of this market.
Interesting. Bob, are the equity markets and fixed income positioned really differently right now, considering we've got these debt ceiling hopes and the AI excitement that was affecting some stocks today, but we also have a Fed that's looking more likely, a lot of people think, than a week or so ago to hike again in June, right?
Yeah, the Fed tightening expectations have really shifted considerably over the course of the last couple of weeks. You know, it wasn't that long ago when basically no expectation of a hike was priced in, and now it's more than 50%. And so you see that picture. And I think whether you look at the stock market or you look at the bond market, what we're seeing is both are indicating a recognition that the U.S. economy is continuing to plug along at a reasonable pace, a pace that is strong enough to continue to keep labor markets tight, and probably more importantly, strong enough to keep inflation reasonably elevated relative to the Fed's target. And so both stocks and bonds are reflecting that we probably need a bit tighter policy on a forward-looking basis than where we were just a couple of weeks ago.